Welcome, curious minds, to the deep dive. Today, we're diving headfirst into a really fascinating story. It's about a company that recently saw its stock price take quite a tumble. And the weird part, it happened right after they delivered what looked like, really stellar earnings.
Yeah, a bit counterintuitive.
Exactly. We're talking about Trip.com Group, or TCOM, big name in global travel. So the question is, was this just a market knee-jerk reaction? Or is there something, maybe something deeper going on that investors are keying into?
Hmm.
We're going to sift through a bunch of different sources today, try to unravel their insights, and really understand the value proposition here. Is this dip an opportunity or maybe a red flag?
Right, and it connects to this broader trend we're seeing, this really profound shift, almost generational, in how people spend their money. People are moving away from just buying stuff,
Yeah.
material goods.
Right, experiences over things.
Exactly. They're prioritizing travel, unique experiences. And that makes the online travel agency sector, the OTAs, incredibly interesting right now. Trip.com Group is right in the middle of all this.
Okay.
So our mission today, really, is to figure out if, say, a dollar of profit from TCM with its super asset-light model, this long growth runway, especially in Asia, is actually more valuable than a dollar from, I don't know, Expedia.
That's a provocative question. One of our sources actually suggested that, didn't they?
They did provocatively suggest it, and we need to dig into the why. What makes this business tick? Why did it surprise the market like that? Let's get into it.
Okay, let's unpack this trend first. The experience economy. Our sources really paint a picture of this post-COVID world where experiences aren't just preferred, they're almost demanded.
Yeah, it's a strong sentiment.
There's this one line I loved. It said something like, an expired passport not completely stamped out would perhaps indicate a decade wasted.
Wow, that's
Total.
evocative.
Isn't it? It just captures this feeling that life's about collecting moments, not, gadgets. So this shift in values, plus economic trends, it seems like the perfect setup for travel companies, not just to recover, but to really boom.
Indeed. And that quote, it really nails the cultural shift, doesn't it? This isn't just some temporary bounce back from the pandemic lockdowns. It feels deeper, more structural. A secular trend where travel spending is becoming a bigger piece of the pie, personal consumption, and it's tied closely to GDP growth,
Especially in Asia, right?
particularly in Asia, yeah.
Yeah.
Fast developing economies, rising middle class, more disposable income, and this real hunger to explore. This gives companies like Trip.com a really, really long runway for growth. We could be talking decades. One source even calls TCM arguably the best travel OTA out there in the market. Bold claim.
That is bold. Is there anything backing that up, or is it just opinion?
Well, it's not just opinion. They point to observations, some anecdotal stuff, but also, more concretely, Google Trends data. It apparently shows TCM's search interest, its adoption, rising compared to even a giant, like Booking.com.
Interesting. So more people are searching for Trip.com.
Yeah, the trend line for TCM is consistently moving up. Now, booking scale is massive, so maybe the slope is different, but TCM's trajectory is definitely pointing upwards. It
Yeah.
suggests they're gaining ground. And in this context, TCM kind of fits that coffee can stock idea.
Ah, the old coffee can portfolio. Explain that for listeners who might not know.
Right. It's this idea of finding a fundamentally strong business, something with durable advantages, buying it, and then metaphorically putting the stock certificate in a coffee can and just forgetting about it for like 10, 20 years.
Riding out the bumps.
Exactly. Trusting it to compound value over the very long term, ignoring the short-term market noise. TCOM, with its position and the travel trend, kind of fits that mold.
Okay, but here's the paradox again. Despite this strong foundation, these great trends, TCOM delivers a double beat in Q4 2024, better revenue, better profit than expected.
Right.
And the stock collapsed yesterday despite a relatively good earnings report. It just doesn't add up on the surface. What triggered that immediate sell-off?
Well, the main immediate trigger seems to have been a wider China market pullback, just broad selling of Chinese stocks.
Ah, the macro picture.
Exactly. Geopolitics, regulations, economic worries. Investors just get nervous and reduce exposure across the board. TCM, being based in China, got caught in that net.
Even though its own results were good.
Right. But there's a really important counter-narrative in our sources. China's president, Xi Jinping, he's apparently made it a priority to vigorously stimulate domestic consumption to drive GDP in 2025.
Okay, that's significant. A top-down policy push.
Very significant. And TCM, with its huge presence in China, its dominant market share there, it's arguably one of the best ways to get exposure to the Chinese consumer if that policy really kicks in.
So you've got this weird tension. A market dip may be driven by sentiment, but strong company performance and a potential policy tailwind.
Precisely. That dual context, the short-term dip versus the long-term potential and policy support, that's what makes it such a compelling coffee can candidate. According to the sources, you look past the immediate reaction to the underlying strengths.
Got it. So let's zoom in on the company itself. Given these dynamics, let's make sure we all understand Trip.com Group properly. What exactly is it? How does it make money? You mentioned asset light. How does that work for an OTA?
Okay, fundamentally, Trip.com Group is an online travel agency, an OTA, and they've been around a while, since 1999. Their money comes mainly from two buckets. Transportation, so flights, trains, buses, and accommodation, hotels.
And accommodation is usually the bigger piece for OTAs,
Yeah.
right? Higher margins?
Generally, yes. More choice involved, more value add in the platform, offer higher commissions than, say, flights. But the crucial thing, the asset light part, is that they act purely as an agent, meaning they don't own the hotel rooms or the airplane seats. They don't hold inventory. They're just the connector, the platform.
So no risk of unsold rooms or anything like that?
Exactly. That makes the model incredibly efficient. It generates a lot of cash because they don't tie up capital in physical assets. It needs relatively low ongoing investment, CapEx. And because of that, it tends to have a high return on invested capital, ROIC, even when the economy goes up or down. Their value isn't in buildings. It's in their tech, their platform, their customer base.
That model does sound appealing, very scalable. But how are they structured to serve this huge market? Seems like they have a lot of different brands. Is that efficient?
Yeah, it's a good question. Their structure is actually pretty strategic. You can think of it simply as having two main parts. A really strong Chinese core business, which is mainly the Ctrip brand.
Okay, Ctrip in China.
Right. And then a fast-growing international arm, which operates under the Trip.com brand. Historically, most of the revenue came from China, from Ctrip. But it's definitely a global company now, using this portfolio of brands strategically. Each one has a role.
Let's break down those brands. What does each one do?
Okay, so Ctrip, that's the heavyweight in China. Over 50% market share, especially if you combine it with Qunar. It offers everything: hotels, flights, package tours, business travel, even fancy concierge stuff for high-end travelers. It's the full-service leader.
And Qunar, you mentioned combining it with Ctrip.
Yeah, they acquired Qunar back in 2015. It complements Ctrip inside China. It focuses more on meta search, comparing prices across different sites. It tends to attract more price-sensitive travelers, maybe younger folks, so it helps them cover more of the domestic market.
Got it. Then the international piece.
That's primarily Trip.com. Launched in 2017, this is their global flagship. Goes head-to-head with Expedia, Booking.com, you name it. It operates in like 24 languages across nearly 40 countries. And the sources consistently call it one of the fastest-growing OTAs globally. That's key.
Okay, Ctrip domestic, Trip.com global. Any others?
Yes, Skyscanner. They bought Skyscanner in 2016. It's a huge global travel meta search site, mostly focused on flights. It gets massive traffic, like 100 million app users a month across over 50 countries. Owning Skyscanner gives them a huge global audience and a platform that's kind of brand neutral, just comparing options.
So Ctrip, Qunar, Trip.com, Skyscanner. Quite the lineup. Does managing all that create complexity?
I mean, sure, it requires good integration and strategy, but the idea is synergy. They cover different segments, different geographies, different functions, booking versus searching. It creates a network effect, really, strengthening the whole group rather than being fragmented.
That makes sense. And there was an interesting fact about India, right? A big stake there. How crucial is that?
Oh, absolutely crucial. They own a huge chunk, 49% of Make My Trip, or MMYT.
Which is the biggest OTA in India.
By far,
Oh.
the undisputed leader. So think about it. They dominate China with TripCanar, and they have this massive strategic foothold in India via MMYT. You could argue they essentially dominate the online travel space in the world's two most populous countries.
Wow.
Yeah.
That's a powerful position, a dual market strategy, as you called it.
Exactly. It sets them up not just for China's growth, but for India's massive long-term potential, too. It's a very strategic long-view play.
Okay, but back in China, how does Ctrip handle local competition? We hear about Meituan, Fliggy. Meituan apparently has a big chunk of the market, like 25%. Isn't that a threat?
It's a nuanced picture. The sources help clarify this. Yes, Meituan is a significant player, especially in certain domestic segments, but they often target different customers and use different strategies.
How so?
Meituan often focuses on lower-tier cities and, interestingly, inbound travel within China. One source mentioned they follow a PDD strategy.
PDD, like Pinduoduo.
Exactly, like Pinduoduo's model. Aggressive pricing, targeting lower-tier cities, maybe more social commerce features. Meta uses a similar playbook for some domestic travel, going after value-conscious users.
Whereas Ctrip is more.
Ctrip generally caters to more affluent travelers and is very strong in outbound travel Chinese tourists going abroad. And crucially, travel is Ctrip's only business. All their focus, R&D, everything is on travel.
Unlike Meituan, where travel is just one part of a bigger app.
Right. Meituan does food delivery, local services, all sorts of things. Travel is just a slice. Ctrip's singular focus gives them an edge in specialization and depth. Plus, inbound travel to China is growing fast now, thanks to easier visa policies. And Ctrip is really well placed to capture that. Many international travelers just haven't heard of Meituan or Fliggy for booking trips into China.
Makes sense. And internationally.
Internationally, the Trip.com arm grew around 70% year over year recently. So clearly, they're competing effectively outside China, too. Diversifies things nicely.
Okay, so summing up the advantages, it sounds like TCOM has some unique strengths, especially riding this Asian travel wave.
Absolutely. The core investment thesis, as the sources frame it, is pretty straightforward but powerful. One, you get unmatched exposure to the world's fastest-growing travel markets, China, India, Southeast Asia. Two, you capitalize on the huge scale of Chinese travelers where TCOM is the leader. Asia's economies are booming, incomes are rising, people want to travel. It's a multi-decade trend fueled by that shift to experiences we talked about. TCOM is just perfectly positioned.
Let's dig into the China advantage a bit more. What makes them especially strong there, beyond just being local?
Two key things, according to the sources. First, market access and bargaining power. Chinese tourists are a huge force globally. TCOM, with its deep roots in China, can negotiate better deals with international airlines, hotel chains, you name it. They have leverage because they control access to this massive pool of travelers. The market's worth over $1 trillion. That's power.
Okay, leverage. What's the second advantage?
Second is native access within China itself. Operating in China can be complex for foreign companies, right? Regulations, culture, policy.
Yeah, we've seen Western companies struggle or pull back.
Exactly. TCOM, being native, navigates that much more easily. That's a huge edge. And like I said, for inbound travelers coming to China, Ctrip is the known, trusted brand compared to local-only competitors.
Yeah.
So they win on both outbound leverage and inbound familiarity.
And beyond China, how are they leveraging this? We mentioned India via Make My Trip. How big a deal is India?
India is widely seen as the next China, potential-wise. Huge population, 1.6 billion people. Per capita GDP is lower now, about 40% of China's, but it's growing fast.
So massive long-term potential for travel demand there.
Massive. That MMYT stake is strategically brilliant for capturing that decades-long tailwind. But it's not just India. They've been grabbing market share aggressively across Southeast Asia, too.
How aggressive?
Sources say their market share in Southeast Asia has grown tenfold in the last 8 years, often at the expense of players like Expedia. They are really pushing hard and succeeding.
Wow, tenfold. Is that kind of aggressive share game happening elsewhere, like in more established markets?
Yes, and this is maybe the most surprising part. They're even taking share aggressively in mature markets like the UK.
Really? Against giants like Booking.com?
Yeah. One source estimated their UK share jumped from maybe 4% to around 24% this year. That's huge. And it seems to be coming directly at the expense of Booking.com.
That suggests their global strategy is working really well, even against entrenched players.
It really does. It suggests their platform, their pricing, their service. It's resonating globally, not just in Asia. It speaks volumes about their execution.
Okay, now for that really interesting, almost quirky detail about their corporate culture, it defies the stereotype of Chinese tech, doesn't it?
Ah, yes. The 996 culture.
Yeah.
9 a.m. to 9 p.m., 6 days a week. It's notorious in Chinese tech.
Right, grueling hours.
But TCOM actively pushes against that, and they have this really unique policy. They give employees an annual cash bonus, RMB 10,000,
Okay.
for each newborn child. Every year, from the child's first birthday until they turn 5.
Wow, that's really generous and unusual.
Extremely unusual, yeah. Not just in China, but globally for a tech company. It signals a totally different approach to employee welfare, work-life balance.
So the fascinating question the sources raises, is TCM thriving despite this seemingly costly, unconventional culture, or because of it?
Exactly. Does it foster incredible loyalty, reduce burnout and turnover? Does a happier, more loyal workforce actually lead to better products, better service, better long-term results?
It's a strategic question about human capital, really.
It is. The sources frame it as a potential differentiator. Makes you wonder about the real ROI of treating employees well.
Okay, let's pivot back to the puzzle, the stock sell-off. If the business is this strong, growing globally, even has this unique culture,
Hmm.
why the big drop? The sources pointed to ballooning expenses.
Right. This is where the market's short-term focus really clashed with TCM's strategy. Let's look at the number that spooked people. FY24 revenue growth was good, almost 20%. Q4 was even better, over 23% year over year. Solid.
Okay, sounds good so far.
But sales and marketing expenses, S&M, grew way faster, 29% for the full year, and a huge 44.5% jump in Q4 alone.
Whoa, 44.5% increase in S&M in one quarter? That is ballooning.
Yeah, and that hit margins directly. EBITDA margins fell from 28% in Q4 of 23 down to 23% in Q4 of 24.
So even though revenue was up, the profit didn't grow much that quarter because costs rose so fast.
Exactly. Not much EBITDA growth at all. And for investors focused on those quarterly profit numbers, that looks like a big red flag. Like costs are out of control.
Okay, I can see why the market reacted negatively to that specific data point. But is it just inefficiency, or is there a strategic reason for spending so much?
The sources strongly argue it's strategic. They call it growth reinvestment,
Meaning?
meaning TCOM is deliberately spending aggressively to capture market share and fuel future growth. Part of that S&M spend is likely discounts.
Ah, like offering cheaper prices than competitors.
Yeah. Maybe they find a flight on Trip.com that's $10 cheaper than elsewhere. That $10 might effectively be TCOM taking a smaller commission or even subsidizing the price, booking it as a marketing cost.
A classic market share grab tactic.
Exactly, especially as they push into new competitive regions like Southeast Asia, where they only really entered a few years ago. They need to spend to get noticed and attract customers. If you look at their total reinvestment, S&M plus product development, it was almost 47% of revenue in FY24. That's a huge chunk going back into building the business.
How does that compare to, say, Booking.com? Did they ever spend like that?
That's a great comparison. Booking's S&M was about 44% of revenue in FY24, but it only grew 9%, much lower than TCM's. TCM's overall profit margins, EBIT margins, are still lower than Booking's, partly because Booking is just bigger and more efficient now, and TCM has higher G&A costs.
Okay.
But here's the fascinating bit. Our sources looked back at Booking's financials from when it was TCM's size, back in like 2013. And back then, Booking's revenue grew 29%, and its S&M spend grew at a massive 47%. Its S&M was about 31% of revenue then.
So Booking also went through a phase of super aggressive spending when it was growing rapidly.
Exactly. It shows this isn't necessarily a sign of trouble. It's often what high-growth companies do in this space to build scale and dominance.
Was there any difference in how Booking handled it back then?
One key difference, the sources noted. Booking kept its other costs, like general and administrative, really low back then, much lower than TCM's are now relative to revenue. That allowed Booking to maintain a pretty high EBIT margin, around 35%, even while spending heavily on marketing.
Okay, so TCM's overall cost structure might be a bit heavier right now.
Potentially. But the main point is this. TCM's management seems to be deliberately choosing long-term growth and market share over maximizing short-term profit margins. The market, the street, might not like seeing those margins squeezed in the short term. They want need spreadsheets.
But management is focused on building the business for the long haul.
It seems that way. The source said management appears nonchalant about the short-term margin impact, prioritizing the long game, accepting that pain now for a stronger position later.
Okay, let's pull back again. Think about the whole OTA industry. Why are these businesses generally considered so strong, so profitable, and what are their weak spots?
Yeah, it's interesting. You might think they're just like Amazon, a marketplace. But because travel tickets are expensive, people naturally shop around, compare prices on different OTAs.
Right. You don't just buy the first flight you see.
Exactly. But despite that comparison shopping, the OTAs have incredible unit economics. Their margins can be huge. Booking historically hit 35–40% EBITDA margins before COVID.
And that's because they don't have the inventory risk.
Precisely. They don't own the planes or hotels. They're the asset-light middleman connecting supply and demand and taking a cut. It's a great model if you can get the scale.
So, using an analogy from the sources, if hotels and airlines are like Nike making the product,
then OTAs are like Foot Locker, the retailer.
Okay. But why can't Nike just sell directly and cut out Foot Locker? Why can't the airlines and hotels cut out the OTAs and save those commissions?
It's a good question. And airlines and hotels do try to encourage direct bookings, but it's incredibly hard for them to replicate what the OTAs offer. Think about the marketing cost for one hotel chain to reach as many people as Booking.com. It's astronomical. Plus, customers like the convenience of comparing everything in one place.
Like that Nike example, they tried going more direct to consumer and it kind of backfired.
Yeah, one source said it backfired bigly. Customers still wanted the choice and comparison shopping at retailers. Once an OTA gets big enough, gets enough customers, it's really hard for the suppliers, hotels, airlines, to bypass them. The OTA controls that crucial customer interface.
But even the OTAs aren't totally free agents, are they? They rely on getting traffic from somewhere.
Ah, yes. That's the key vulnerability. Most OTAs are, to some extent, captive to an even bigger aggregator, Google.
Google as the shopping mall.
Exactly. Google is where most people start their travel search. It aggregates all the OTAs, the retailers, and gets paid rent through advertising spend, SEO efforts, to make sure those OTAs show up high in search results.
So the OTAs are competing with each other inside Google's mall and paying Google for the privilege.
Pretty much. They don't fully control their own traffic source. Google does. It's a power dynamic that benefits the super aggregator.
So how does Trip.com try to break out of that? How do they avoid just being another tenant paying rent to Google?
That's exactly why they're reinvesting so much. That heavy spending we talked about. It's partly aimed at gaining more control over demand, becoming the first place travelers go.
Bypassing Google search.
Bypassing the dominant search platforms, as one source put it. Their strategy involves entering new markets directly, beefing up their inventory so they have everything, creating a great user experience, and providing top-notch customer service to build loyalty.
And the key tool for that is?
The smartphone app. The app is their flagship store. By building really useful features directly into the app, like embedding train booking QR codes, which is huge in China, they want to make the Trip.com app the default starting point for travel, the go-to tool in your pocket.
Make it indispensable.
Exactly.
Yeah.
Become the habit, not just an option found via search. And it seems to be working to some extent.
How so?
Well, in 2024, the Trip.com app was apparently the third most downloaded OTA app globally, ahead of giants like Expedia and Agoda.
Wow. Still behind Booking and Airbnb, though.
Still behind those two, yeah. But significant progress in building that direct channel and reducing dependency on Google. That's the long-term play behind the reinvestment.
Okay, let's get bang up to date. We have some fresh numbers, unaudited results for Q2 2025, released just recently, August 27th. What's the headline from this latest data? Does it confirm their strategy is working?
Yes, the headline is very positive and directly supports the strategy. The key takeaway is that their international businesses kept up really strong growth across the board in Q2. Overall, bookings on the international Trip.com platform were up over 60% compared to last year.
60%, that's huge growth.
Huge. And inbound travel into China surged over 100% year over year. That's fantastic news.
Doubled. Wow.
Yeah. And outbound travel, Chinese tourists going abroad, bookings for hotels and flights were over 120% of the pre-COVID level from 2019.
So not just recovered, but significantly bigger than before the pandemic.
Exactly. These are really robust numbers. It shows powerful momentum, especially internationally, validating those big investments.
Management must be pleased. What are the execs saying? James Liang, Jane's son.
They sound confident, yeah.
Yeah.
Chairman James Liang talked about travel being a key driver in national growth and global engagement, an engine for economic development, and a catalyst for cultural exchange. He emphasized their strategic investments in innovation, partnerships, and especially that inbound travel push.
Connecting it back to the bigger picture.
Right, and CEO Jane's son echoed that, focusing on capturing demand from every demographic, really highlighting inbound travel again, and enhancing services to give global travelers seamless local experiences. It all reinforces that strategic spending is tied to these big goals.
Okay, let's get into the Q2 financial specifics. How did the revenue break down by segment? Where's the growth strongest?
Okay, overall net revenue hit RMB 14.8 billion. That's about US $2.1 billion. Up 16% from Q2 last year and up 7% from the previous quarter, mostly driven by strong holiday travel.
16% year over year is solid. How about the segments?
Accommodation did really well. RMB 6.2 billion, up 21% year over year and 12% from Q1. That's strong growth in a key area.
Very nice. Transportation.
Transportation ticketing was RMB 5.4 billion, up 11% year over year, but kind of flat compared to Q1. Still solid, steady performance there.
Package tours.
That was RMB 1.1 billion, up only 5% year over year, but up 14% from Q1, probably helped by holidays.
And corporate travel?
Corporate travel hit RMB 692 million, up 9% year over year, but a really strong 21% jump from Q1. That suggests business travel is recovering nicely and they're gaining share there.
Okay, interesting mix. Now, what about those expenses? The S&M and product development costs that caused concern before, still ballooning in Q2.
This is key. S&M expenses in Q2 were up 17% year over year, reaching RMB 3.3 billion. That's 22% of revenue. Product development also grew 17% year over year to RMB 3.5 billion, or 24% of revenue.
So, still growing at 17%, but that's way down from the 44.5% jump we saw back in Q4 24, right?
Exactly. It's much more controlled growth. The percentage of revenue is pretty consistent with the year before. It looks like continued strategic investment, not runaway costs.
And did profits hold up despite this investment?
Yes. Net income for Q2 was RMB 4.9 billion, or US $681 million. That's a nice jump from RMB 3.9 billion in Q2 last year. Adjusted EBITDA was also strong at RMB 4.9 billion, US $680 million, up from RMB 4.4 billion.
Okay, so the bottom line is growing nicely even with the continued spending. The investments seem to be efficient.
It certainly looks that way based on these Q2 numbers.
Yeah.
They're spending, but they're getting strong revenue growth and improved profits.
And what about Pash? Do they have a strong balance sheet? What are they doing with the money they're making?
Oh yeah, their cash position is rock solid. As of June 30th, they had cash equivalents, restricted cash, short-term investments, totaling RMB 94.1 billion. That's over US $13 billion.
$13 billion. That's a huge war chest.
Huge. Gives them massive flexibility. And they're using some of it to return capital to
To
shareholders.
share buybacks.
Yep. They bought back 7 million ADSs for $400 million under an existing plan.
Yeah.
And then just in August, the board approved a new repurchase program for up to US $5 billion worth of shares.
$5 billion. That's a massive buyback authorization.
Massive. It signals huge confidence from management in their valuation and future prospects. A very strong commitment to shareholders.
Okay, one last piece on the outlook. Earlier sources mentioned potentially poor guidance for FY25, maybe below expectations, which could have hurt the stock. Does this strong Q2 change that perspective?
It's a good point. That earlier source did mention FY25 guidance might be around 14–15% growth, with margins maybe a bit lower than the street wanted. That could definitely have been a factor.
Right.
However, that same source also noted TCOM has a history of beating estimates, and management is well regarded. So this really strong Q2 performance, especially the international growth and solid profits, it suggests that maybe the official guidance was conservative.
Under-promising to over-deliver.
Could be. Or just giving themselves room to keep investing strategically. Either way, the actual operational momentum looks very strong, maybe stronger than the guidance implies.
Okay, let's bring it all together. Valuation. After diving into the strategy, the market, the culture, these latest numbers, how should we think about TCM's stock price now, especially compared to peers? Is that idea of TCM's profit being more valuable holding up?
Right, the valuation puzzle. Sources say around $59 a share. TCOM trades at about 12 times its FY24 EBITDA, and maybe 11 times its estimated FY25 EBITDA. If you look at it on an EBITDA minus CapEx basis for FY25, which adjusts for how much they need to reinvest in the business, it's also around 11x.
Okay, 11–12x EBITDA. How does that compare to Expedia?
That comparison is really stark. Expedia EPE is growing much slower, right? 7% revenue growth last year, guided for 5% this year. It's also got lower margins and needs way more capital investment, like 8 to 10 times TCOM's CapEx, even though its revenue is only double TCOM's. It's a much heavier business.
So TCOM seems better on growth, margins, capital efficiency.
Qualitatively and quantitatively superior, according to the sources. Yet, the market values TCOM at only maybe 2 turns of EBITDA, higher than Expedia.
Only 2 turns more.
Yeah. And even more strikingly, on that EBITDA minus CapEx metric for FY25, TCOM actually trades lower than Expedia.
Wow. That implies the market isn't fully valuing TCOM's better growth and asset-light model.
That's exactly the argument. It suggests a potential mispricing, an undervaluation relative to a slower, more capital-intensive peer.
Okay, what about the benchmark? Booking.com. How does TCOM stack up against the best-in-class?
Booking, BKNG, trades at a much higher multiple, around 18 to 20 times EBITDA, maybe 22 times on an EBITDA minus CapEx basis. Big premium.
Which is deserved given their scale and profitability.
Largely warranted, yeah. Even though their growth is projected to be slower now, around 7%, the sources suggest TCOM could trade higher. Its 52-week high was $77, and even that would still be at a slight discount to Booking.
So why the persistent discount for TCOM compared to Booking?
It nearly always comes back to the China discount. The market simply applies a higher risk premium, a higher discount rate, because TCOM is headquartered in China, geopolitical risk, regulatory risk. it gets penalized.
The famous China discount, it affects so many companies. But TCOM is becoming more global, right? Could that help mitigate the discount over time?
That's the multi-billion-dollar question, isn't it? TCOM is structured as a Chinese company. It uses that VIE structure.
Variable interest entity, which some investors don't love.
Right. It creates legal and regulatory questions for some. But the international part of the business is growing so fast. Sources estimate international revenue is now maybe 20% of the total. Just a couple of years ago, it was under 10%.
That's a big shift.
Huge. And the implication is, maybe a few years down the road, we look at TCM and say, hey, this isn't really just a China business anymore.
If 30%, 40%, 50% of revenue comes from outside China?
Exactly. Does the rationale for such a steep China discount still hold? As the business becomes more globally diversified, it theoretically should reduce that country-specific risk premium.
But the VIE structure itself might remain a concern for some, regardless of where revenue comes from.
That's definitely a valid point, and commenters on the source material brought it up. The legal structure is separate from the operational footprint, so it's a risk factor that probably won't disappear entirely. But the growing internationalization could certainly help lessen the perceived overall risk.
Okay, so wrapping this deep dive up. Trip.com Group is clearly much more complex than just a Chinese travel site. It's a global player, riding huge trends like the experience economy, dominating massive growth markets like China and India, and pushing aggressively into others, even mature ones.
Yeah.
We've seen their strategy of heavy reinvestment, their unique way of tackling the OTA power dynamics through their app, and solid recent financials that seem to validate their approach. But it's all packaged in a valuation that, compared to peers, looks like it might not fully appreciate these strengths.
Absolutely. The market seemed to react to the short-term expense jump and maybe the China label, but looking deeper reveals these calculated long-term strategic moves. They're playing the long game, trying to build their own ecosystem, reduce reliance on search engines, and own the customer relationship through that app and strong brand portfolio. The Q2 numbers really back up that the strategy is delivering growth.
So for you, our curious listener, here's something to chew on. Given Trip.com's relentless international growth, its success in making its app a go-to travel tool, and that undeniable shift towards spending on experiences, how much longer can the global investment world keep seeing TCOM primarily as just a China stock and apply that significant discount?
Right. As it becomes more global, does that label still fit?
And what does the rise of players like Trip.com mean for the whole global travel platform landscape going forward? Lots to think about. We encourage you to keep exploring, keep questioning. Join us next time for another deep dive into the insights that matter.